Hello and welcome to this session in which we're going to be working with Chapter 4. Chapter 4 deals with long-term financial planning and growth. In the prior session, we looked at financial planning model first look, which is we simplified the example. In this session, we're going to look at the sales approach. So make sure if you haven't watched the prior session, it's helpful to view the prior session to understand the simplified version of financial planning before we move into a little bit more, I wouldn't say advanced, because this could be very, very advanced, but a little bit more involved. So let's go ahead and just introduce this session, and we'll start to work the example to illustrate the point. So in the previous section, this is what we did. We described a simple planning model in which every item increased in the same rate as sales. And we say this is a simplification, an oversimplification. This may be a reasonable assumption for some elements. So for some elements, that's the case. They do vary in proportion with sales. For others, such as long-term borrowing, probably it's not. When sales goes up, you don't have to borrow more money. That's not necessarily true. That's what we're saying here. The amount of long-term borrowing is something set by management, and it's not necessarily related to sales. Sometimes if sales goes up, you may have to borrow less if you're bringing the cash. Okay, so there's no relationship. This is just one example. In this section, though, we're going to describe an extended version of our simple model. It's still going to be simple, I believe, but it's an extended version. The basic idea here is to separate the income statement and the balance sheet into accounts into two groups. Those that varies directly and those that do not. So we're going to look at certain accounts, and we're going to say some accounts, they vary directly with sales. So when sales goes up, those accounts goes up. When sales goes down, those accounts goes down. And we could assume by the same percentage or by a different percentage, it doesn't matter. Then we're going to look at accounts that do not change. So if sales goes up, no change. If sales goes down, no change. They're not related to sales. So given a sales forecast, we will be able to calculate how much financing the firm will need to support the predicted sales level. So we're going to look at the example to find out what is our needed fund to support our operation. The financial planning model we describe next is based on something called the percentage of sales approach, basically using sales as your driving force, that's the case. Our goal here is to develop a quick and practical way of generating a pro forma statement. We defer the discussion of some bells and whistles to later sections. Of course, this is a simplified version. So first, we're going to look at the income statement that we are giving, and what I did is I have the income statement right here. So we have sales, we have cost of sales of 800, taxable income is 200, 1,000 minus 800, we're going to pay 34% taxes. 34% taxes, it means we're going to have to pay taxes of $68. Then what we're left with, 200 minus the taxes, it's going to give us $132 in net income. What we did from net income, we paid out $44 in dividend and we kept 88. So we paid for 44, we kept 88. Now I just want to emphasize this one more time. Dividend and retained earning are not income statement accounts, so don't think dividend is an income statement account. They're listed here because dividend is paid out of net income, just for practical reasons they're here. Okay? So now what we're going to do, we're going to project. So Rose & Garden has projected a 25% increase in sales forecast in the coming year. So now we're going to generate a pro forma income statement based on a 25% increase in sales. We assume that total assets will continue to run at 80% of sales. So your cost is 80% of sales. With this assumption, we could prepare a pro forma income statement. Okay? So let's take a look at the pro forma income statement. So what we're assuming is sales will grow by 25%. So we're going to take sales multiplied by 1.25, and that's our new sales. Cost of sales is 80%. So we're going to take sales times 0.8. So cost of sales, the new projected cost of sales is 1,000. Now, taxable income is sales minus cost of sales. That's our taxable income, 250. We're going to have to pay taxes 34%, so 250 times 0.34. That's going to give us the taxes. And 250 minus the taxes of 85, it's going to give us our net income of 165. Excellent. Now we just prepared our pro forma income statement. Pro forma income statement. Now, let me see if I can eliminate this column. This way things would look a little better. Maybe I could increase the size. Okay, now I can increase the size a little bit, showing both of them side by side. Let me see, maybe this is better. Yeah, it messed up the format up there, but it's okay. Now, the next thing we want to think about is, of that 165, we need to know how much we're going to pay out in dividend and how much we're going to keep. Well, we're going to keep the same policy. We're going to assume to keep the same policy. What does that mean? Last year, so now we're going to be working with the prior year. Last year, we paid $44 out of 132. So $44 out of 132, that's going to give us 33.33%. They should have used a different figure. Then what does that mean? If we are paying 33.33, it means we are keeping the remainder, and the remainder should be 66.67 or 66.6667 rounding. It doesn't matter how you look at it. So we're going to keep 33. We're going to pay out, we're going to keep 66.67. We're going to pay out 33. Well, we're starting the planning now. Now what we could say, we're going to take 165 multiplied by the payout ratio, the 33.33 is called our payout ratio. Let me just write it down because we need to know this term. This is the payout ratio, and this is important. It means how much we pay out of dividend. We pay out 33%. Now, if this is the payout, this is called the retention ratio. Retention means it's what's going to be left and what's going to add it to our retained earnings. So 165 times this percentage, that's going to give us 110. And notice if we take 55 plus 110, it's going to give us 165. So notice what we did right now. We figured out our dividend and our what's going to be added to our retained earnings. So this is what we did. This, and those, again, those are projected. Obviously, this is projected. Everything is projected. Okay, this is projected and this is projected. Because this is what we're doing. Okay, because if anything that changes here, it's going to change the dividend and the and what's going to be left for retained earnings. So basically, we're done with the income statement. Once again, dividend and retained earning are not income statement, but for the sake of this, we're going to assume. Now, we're going to move to the balance sheet. So let's go down to the balance sheet. And here's the balance sheet for this company. So here's the balance sheet. Okay, this is the balance sheet. And here's what we're going to assume. We're going to make certain assumptions. We're going to assume that certain account will vary with sales, and others do not vary with sales. So we're going to assume certain vary with sales and the others do not. Okay? And starting with cash, right now we have cash of 160, account receivable of 440, inventory is 600, property, plant, and equipment 1,800, total asset of 3,000. We have liabilities of 300, notes payable of 100, total of 400, current liabilities, long term that is 800, common stock and paid in capital 800, retained earning is 1,000, total 1,800 of equity plus debt equal to 3,000. Everything matches. Let me just double underline this just to make sure. And there we go. Okay. Now, here's what we're saying. We're saying the asset side, most of them, they vary. Okay. For example, notice what we assumed here. We assumed that inventory is 60% of sales. How did we come up with the 60%? Well, we said, if we took our inventory account, because sales is driving everything, divided by sales, inventory is 60% of sales. Cash, if we take 160, because everything is, we're saying, relative to sales, cash is 16% of sales, and obviously account receivable varies with sales, varied with sales. So it's 44% of sales. Okay. Also, we assume that property, plant, equipment is an account that varies with sales, and it happens to be 180%. And we're gonna look at those assumptions later on. And this makes sense. I mean, at least from the cash, account receivable, and inventory, they vary with sales. Not so much with net property, plant, and equipment. We'll talk about that later on. We're also gonna assume that. Okay, what we're saying also too, total assets. If we look at total asset right now is in relationship to sales, it's 300 of sales. Okay, this last ratio, the 300 ratio, this is called the capital intensity ratio. And this tells us the amount of asset needed to generate $1 of sales. It means to generate $1 of sales, we need $3 in assets. For every dollar in sales, we need $3 in assets. And notice here we have 3,000 in assets, and we had currently 1,000 in sales. This is, it seems, assuming this relationship holds, this is what we called our capital intensity ratio. Okay, so the higher this ratio, the more capital intensity this firm is. So it means the more assets they need. Okay, so that's that. And we talked about liabilities. We assume that the only thing that varies with sales from the liabilities is only accounts payable, and this should make sense because if you buy more, you're gonna need more. If you're selling more, you're gonna need to buy more on account. Now, notes payable doesn't have to vary like debt. This is a form of debt. Loans. Notice they don't vary. Equity, usually they don't vary. Okay, so they don't vary. Now, retained earning, it's going to vary because we're going to do some additions to retained earning. But this is basically what we are assuming. Now we are ready to prepare our partial pro forma income statement. So given this information, let's go ahead and start to prepare our pro forma balance sheet. Okay, so we talked about the capital intensity. I could erase this. So now let's prepare our pro forma. Now, starting with cash, what are we saying cash? What we said is cash is 16% of sales. Well, that's easy. So all I have to do to project my future cash, okay, we're gonna find out what my sales is. My sales is 1,250, and cash, it's gonna be, I'm gonna multiply it by 16%. And my cash should be, or my projected cash should be 200. Why is it 200? Because cash is 16% of sales. So sales is 1,250 times 16%. Let me do this one more time. I want to make sure you know how did this number came along. My sales, my new projected sales is 1,250 times 0.16. Why 0.16? Because we said here that cash represents 16% of sales. We're gonna do this. We're gonna do the same thing for receivable, and the same thing for inventory, and the same thing for fixed asset. Okay, so let's go ahead and do the same thing. And basically, sales, we already know it's 1,250 for our purposes. So I'm gonna take 1,250. I don't want to use the formula because I don't want to keep going up and down. Multiplied by 0.44. This is the account receivable. Inventory is 1,250. We keep inventory 60% of sales. 750. Now I know what's my total current asset. So my total current assets are those three. So this is my total current asset, 1,500. And what we notice, just kind of to put the differences, is notice cash increased by $40, account receivable increased by 110, and inventory increased by 150, and overall current asset increased by 300. Now, property, plant, and equipment, what we're saying is they're 180% of sales. Okay, let's do this. So 1,250 times 180%, we need property, plant, and equipment of 2,250, and that's an increase from the prior year of 450. Now we can find our total asset. So total asset is current plus long term, and overall total asset increased by 750 overall. Now, if you want to find out what is our capital intensity ratio, we'll take 3,750 divided by 1,250, which is sales, and voila, it's still 3. So our capital intensity ratio is still 3. Okay, so we completed the pro forma balance sheet. Now let's go ahead and complete the current liabilities balance sheet. The accounts payable, it's going to be changing with sales, and accounts payable, we said it's one of these accounts that's going to change, and it's 30% of sales. So we're going to take this amount, multiply it by 0.3, 30%, multiply it by 30. And liability should be 375, which is an increase of $75. Okay. Now what we're gonna say is the other accounts, they did not change. So notes payable did not change. That's 100 because it says it doesn't change. Now our total current liabilities is 475. We're assuming that total debt did not change. Long-term debt did not change. We assume that stockholders' equity did not change. We assume that for now, retained earnings, actually retained earnings, we know it changed. How did we know it changed? Because when we prepared the income statement, we said that we're gonna keep 110. Therefore, we're gonna add this 110 to retained earnings. Oops, that's common stock. Sorry, this is 1,000, the previous retained earning, plus what we said we're gonna keep. We calculated earlier, 110. And common stock will be at, what's common stock? Common stock is 800. How come I have too many 800s here now? Let me just check something. Oh, common stock is also 800. Wow, okay. Why do they do this? They should use at least different numbers. Okay, so common stock is 800. Now we can find total equity. Total equity is 1,910. If we look at, if we take current liabilities plus long-term liabilities plus equity, which is 1,910, and this should give me 3,185. Okay, now let's just make sure we understand that the only thing that changed is retained earning and increased by 110, and the others here, they did not change. Now here's a problem. What's my problem? My problem is this. My problem is my total liabilities and equities are 3,185 and my total asset are 3,750. What does that mean? Well, simply this means I need external funding, because if my assets increase, my liabilities and equities should increase by the same amount. They did not. So I need a plug. Okay, and the plug is 565. So, in other words, I'm in need and financing, external financing of 565. Okay. Now, the question becomes, how do I come up with this financing? Okay, how do I come up with the financing? Okay, let's read a little bit about financing, then we'll determine how we're gonna do the financing. But hopefully you see, because the balance sheet does not balance, 3,750 is not equal to 3,185. 3,185 need to be 3,750, because if assets goes up, liabilities and equity should go up by the same amount. So let's take a look at, read a little bit more, then we'll come back and we'll work. Okay. So this is basically what we call the good news, bad news scenario. Our sales went up, but now we need external financing. Okay, so sales went up by 25%. The bad news is that it's not going to happen unless we borrow money, because our asset went up. We need to finance the asset. Remember, sales goes up, asset goes up. We need to finance those. Okay, this is a good example of how the planning process can point out problems and potential conflicts. So this will tell you ahead of time what you need to do. I'm going to be short, so you need to come up with the financing. If, for example, the company has a goal of not borrowing any additional fund and not selling any new equity, then 25% increase is not feasible. So what we're saying is, if the company said, you know what, the company policy is not, we don't want to borrow, we don't want to raise equity, then they should not increase their sales by 25%, because they're going to be short. They're not going to be able to finance themselves. Okay? Because we know if that happens, they're going to need 565. If we take the need for 565 and a new financing is given, we know that we have three possible sources. So where can we get the money from? We can get it from short-term debt, short-term borrowing. We can get it from long-term borrowing. So we could borrow on the long-term, we could borrow on the short-term, or we can issue equity, which is stocks. So those are the three options, 1, 2, 3. Actually, or a combination of those. It doesn't have to be, they don't have to be exclusive. So short-term borrowing is 1, long-term borrowing, or new equity, which is stocks. The choice of some combination among these 3 is up to management. We will illustrate only one of many possibilities. Now remember, you could do so many things. Okay, so we're gonna work with some possibilities. Suppose that we decided to borrow the funds needed. That's it. We're gonna go with 565. In this case, the firm might choose to borrow some over the short term and some over the long term. So we need 565. What are we gonna do? For example, current asset increased by 300, whereas current liabilities rose by 75. So what we're going to borrow, we said because assets now are 300, current assets are 300, which they increased by 300. We want to borrow 225 from short-term debt. Well, if 225 is short-term, what's going to be left? 340. We're going to borrow it long-term. Okay? Because here what they assume for short-term, current assets increased by 300 and current liabilities increased by 75. So they want to increase current liabilities by the same amount of current assets. So that's why they decided 225 short term, 340 long term. Now we are ready. All we have to do now for the balance sheet to balance, we have to add 225 to our current debt and 340 to our long term debt. So going back to this picture, so I'm gonna copy the information that I already completed. The asset section is already completed 100%. So I'm just gonna copy and paste. I'm gonna copy and paste values. And I want only the values. So the asset section has been completed. Now liabilities, let's do the liabilities. We said accounts, we already figured out current liabilities, 375. Short-term notes payable. Short-term notes payable, it's gonna go from 100. It's gonna go from 100, and we decided to borrow an additional 225. So notes payable is 325. And remember, why did we go with this? Because we said current assets increased by 300, this number here. So we said let's increase current liabilities, basically bring it to the same increase. So that's how they came up with this structure. This is only one solution. This is only one solution. So now we have current liabilities of 700, which make it an increase. If you're looking at 700 minus the prior current liabilities, let me see, minus the prior current liabilities. Oh, so yeah, we increased it by 225. Okay, that's why 75 here. We increased this one by. Hold on. Accounts payable increased by 75, and this is increased by 225. Therefore, the total increase is by 300. So that's why they wanted the increase in current liabilities equal to the increase in current asset. That's what they wanted to do. So we just highlight this. They want this and this to equal to each other. That's why they went with short term of 225. Now this is 700. Long term debt, remember they're going to rely on an additional $340. So they're going to take 800 from the prior, plus they're going to add 340, which is 1,140. No new equity. It's going to be common stock. It's going to be 800. And common stock is 800. And retained earning, it's 1,110. Total is 1,910. So if we take equity plus long-term debt, plus long-term debt plus short-term debt, it's equal to 3,750, and voila, we made it balance. So this is what we did in this scenario. We completed a pro forma balance sheet. Now we need to talk a little bit more about what we did, and this may not be how it actually happens. Again, we're oversimplifying here. Okay, we're less than the prior example, but we're still oversimplifying or simplifying. Not oversimplifying. The first example was oversimplification. So let's read a little bit about what could change, and maybe as you're working this example, you might be saying this doesn't have to be true. And yes, certain things does not have to be true. So let's take a look at those things that doesn't have to be true in our scenario. Okay, so what did we assume here? We make a lot of assumptions. Let's talk about the assumptions. One thing is fixed asset. You remember this account here, fixed asset. Let me just scroll up here. Fixed asset was, when we started, fixed asset was 1,800, and we said it's 180% of sales. So this is one assumptions we made. So let's talk about this assumption. The assumption that fixed asset, well, by nature they're called fixed asset, the percentage that, the assumption that assets are fixed percentage of sales is convenient, very convenient, but it may not be suitable in many cases. In particular, note that we effectively assume that this company was using its fixed asset at 100% capacity. So what we assumed is fixed asset were being used at 100% capacity. In other words, if we need to increase our sales, we need more fixed asset. That doesn't have to be true. You might have fixed asset, but if you're not using them at 100% capacity, if you increase your production, you don't have to increase your fixed asset because you have the capacity. You have the hours, the machine hours, the space, the warehouse. That you don't need to buy additional ones. Okay, so we made that assumption. That's not necessarily true, because an increase in sales lead to an increase in fixed asset. That's not necessarily true. For most businesses, there would be some slack or excess capacity, and production would be increased by perhaps running an extra shift. Okay, according to the Federal Reserve, the overall capacity of the U.S. manufacturing companies in November of 2013 was only 76.8%, up from a low in 2009, 64.4%. So notice, U.S. manufacturing companies, they're not using all their capacity. So if they increase their sales, it doesn't mean they need new fixed asset. It doesn't mean they need new equipment. It doesn't mean they need new warehouses. It doesn't mean they need new vehicles, trucks, delivery equipment, because they're not using them at full capacity. Here's more specific examples. In January 2012, Volkswagen announced that it would spend $7 billion in North America over the next 5 years with the goal of selling 1 million vehicles in the US by 2018. That's their goal. At the same time, GM announced plans to close 2 Australian plants and reach a deal to close the company's Opel plant in Germany. About 6 months before, Ford announced that it's closing its 2 largest Australian plant as well. Evidently, GM and Ford has excess capacity, whereas Volkswagen did not. So if you're closing plant, it means you're not using them, so close them, because assets, they cost you money to maintain and they're not producing sales. So in other words, companies may not be using their full capacity, so fixed asset doesn't have to change. It doesn't have to change with sales. It doesn't have to. It might, but it doesn't have to. Let's take a look at another example that's coming from your table kitchen. Another example, in November 2013, ketchup maker Heinz announced it was closing 3 factories in North America. The company stated it would increase production at other plants to compensate for the closing. So there's 3 production, they closed 3 and they increased production. Okay, apparently they had significant excess capacity, so that's why they closed them. Now we need to learn about another ratio. Okay, if we assume that this company, Rosen Garden, is operating at only 70% capacity, then the need for external funds will be quite different. We say that they're operating at 70% capacity. We means that current sales level is 70% of the capacity of the full capacity sales level. So here's what's going to happen. If we assume they are operating at 70% capacity, we're going to take their current sales, okay, and divide it by 70%. Okay, so if we so this is the full capacity sales. So to figure out the full capacity sales, you will take your current sales divided by the full capacity. So if we take 1,000 divided by 70, it's going to give us full capacity sales. So if they're using 100% of their capacity, their sales should be 1,420. So simply put, let me show you. If this is their capacity, they are using 70% of it. And at 70%, they are producing $1,000 in sales. So basically, they still have 30% of their capacity unused. So if you want to translate this 30% in sales, take 1,000 current sales divided by the capacity used, it's going to give you 1,429. So once they reach their capacity, 100% of their capacity, they can still generate 1,420 without the need of new fixed asset. Okay? This tells us that sales could increase by another 43%. Why 43%? Well, 429 divided by 1,000, this should be 43%. So they could increase their sales by an additional 43% without the need of any new fixed asset. And in our situation, they only increased their sales by 250. So they're going to increase their capacity, but they don't need new funding because, 25%, 1250 is someplace here. Okay, 1250 in sales. They did not use their capacity. Okay, in our previous example, we assumed that it would be necessary to add 450 in net fixed asset. If you go back to the fixed asset example that we did, we went from 1,800 in fixed asset to 2,250, which is we increased fixed asset by 450. That's not true. We don't need this much. We don't need this much new fixed asset. Okay. So in current scenario, no spending on fixed asset is needed because sales are projected to rise to 1,250, which is within the capacity, which is substantially less than the full capacity of 1,429. So we don't need new fixed asset unless we reach above the sales level of 1,429. And hopefully at that point, company will find new ways to increase their capacity. I'm just assuming here. Okay. As a result, our original estimate of 565 in external funding is way too high. We estimate that 450 in new fixed asset would be needed. Instead, no spending in fixed asset is necessary. Thus, if we are currently operating at 70% capacity, it means we're going to take the 565 original estimate, reduce it by 450. We don't need new fixed asset, so we only need $115 in external funding. So now this 115, we could either choose short-term, long-term, or a combination, or sell some equity. Okay? So simply put, the balance sheet would look something like this. So the balance sheet would look something like this. Let me just erase this stuff. So, and show you what the balance sheet would look like in case let me just delete this. Okay, move it out. Move it out of the way. So this account here, I'm going to keep it at 1,800. At 1,800, I only need financing of notice of 115. Okay, then I will just have to increase maybe my notes payable, or a combination of notes in long term, or just long term, or just long or short term. It is my option. It is my option to do this. All right, so hopefully working this example, it's going to help you determine the percentage of sales approach. The next topic is external financing and growth, and some caveat regarding financial planning. Again, make sure to read your textbook. If you have any questions, by all means, email me or see me in class.